Welcome to the 2021 Annual Shareholders Meeting presentation for W.T.B. Financial Corporation. My name is Larry Sorensen. I'm the Chief Financial Officer of both W.T.B. Financial Corporation and Washington Trust Bank. You found this slideshow on our investor relations website. I believe the slide deck will also be there and available for your viewing. Second slide are forward-looking statements. You're welcome to review that at your leisure. I won't go over it here. And we'll start with an overview of the company, and many of you have seen these slides before. We've got our three-state geography, Washington, Oregon, and Idaho, and that's been true for a number of years. And we've got our mission statement, and I've highlighted a couple themes in the mission statement that we try to live up to and help guide how we run the company. We want to be the best. We want to tailor our efforts to the financial needs of our customers. We want to build long-term relationships with our customers. We want our people to be empowered to act on behalf of their customers. We follow certain guiding principles, all of which are designed for the long-term health and viability of the institution. Our core identity, as we view ourselves, are Pacific Northwest Regional Bank. We've got over 110 years of heritage. Fourth generation chairman of the board and CEO, and Peter Stanton. It's largely privately owned with family heritage. We run the bank, again, with certain guiding principles, a conservative risk profile, balance sheet strength, discipline around capital management. We look at ourselves in terms of risk-adjusted performance, operating within our own internally established risk parameters. And we strive for long-term franchise and shareholder value. Our business model is a relationship bank business model. We are not a transactional bank. We want and have relationships with our customers where we value them and they value us. And that, we think, translates into high-value customer relationships. It also compels us to kind of be governed by our ability to compete in the marketplace and grow our bank organically. We have a broad product line encompassing commercial banking, which is really our primary focus, retail and private banking clients, and also a wealth management and trust business. In terms of financial management principles, balance sheet strength is something that we try to maintain at all times. We spend a lot of time and effort trying to understand balance sheet structure and composition so we have good balance with our risk profile and the strength and capacity to withstand the unexpected embedded in the balance sheet. Shareholder value and capital discipline is an important part of the principles of our financial management philosophy. And finally, a consistent risk-adjusted performance, again, operating within our own established risk parameters, trying to ensure durable and recurring earning power across the business cycle. In terms of big themes and issues for 2020, of course, we had the global pandemic, a major shock across the globe. And that led to a very volatile economic landscape, unprecedented financial market activity, and Federal Reserve intervention in the capital markets, and kind of the company response from our perspective, navigating our way through that difficult environment. We came in intentionally intended to be positioned to withstand the unexpected, getting back to the notion of balance sheet strength. Through the downturn, we were able to provide credit support to our borrowers that needed it, in particular through the PPP, the Paycheck Protection Program of the Small Business Administration, and payment deferrals for clients that needed a little help over the most difficult part of the environment. And from that and from our performance through the year, we had tremendous deposit inflows, which drove high levels of liquidity and balance sheet growth. Earning power not only was maintained throughout the year, but actually grew throughout the year. Significant provision expense during the year fortified our allowance position, even in the absence of significant charge-offs. And that provision expense did drive earnings down year over year, but still quite solid given the circumstances. In terms of the operating environment, we go back and we look at gross domestic product and the change in that, comparing back to the Great Recession versus the COVID pandemic. Gross domestic product plunged 31.4% in the second quarter of 2020, and then quickly recovered, growing 33.4% in the third quarter of 2020. It was quite a remarkable thing to witness. In terms of the unemployment rate spiked from 3.5% to 14.8% in just 2 months. Truly an extraordinary environment. In terms of interest rate landscape, if you look at the yield curve and you look at the short end of the curve on the graph here in the upper left-hand corner, way back in the Great Recession, the Fed drove short-term rates down 500 basis points to near zero, held them there for a number of years, then allowed rates to rise in 2016, 17, and 18, and then they began to fall again and then plummeted in the spring of 2020. But only had 250 basis points to go before they reached what's called the zero bound. And then you look at the longer end of the curve, and that's where the Fed's quantitative easing monetary policy came into play, pushing the longer end of the curve, longer duration bond instruments, 10 years and further out in the curve, pushing yields on that down, flattening the yield curve. And you can see the 10-year Treasury has kind of reached successive new historic lows over the last decade or so, bottoming out below 50 basis points in the summer of 2020. With that, if you go back and kind of take a long view of rates from 1990 to the present, history of the rate environment has been lower highs and higher lows across that whole time horizon, leading us down into rate levels that are uncomfortable and difficult for a financial institution. The implications of that long slide of rates and really bottoming out in the summer of 2020 is elevated loan pricing pressure, accelerated refinance activity, lower reinvestment yields. Funding costs essentially hit the zero bound and are roughly, generally speaking, constrained by the zero bound, even while asset yields are continuing to be under pressure. That leads to margin compression and earnings challenges for us and the industry. In terms of industry themes, a remarkable year. Many, many growth records for the industry. Assets increased $3.2 trillion or 17% in over a one-year period. And the next highest annual asset growth for the industry was 11%. Securities for the industry in general increased $1.1 trillion or 28%. The next highest annual growth in securities for the industry, 23% in 2009. Cash position in the industry. The industry is awash in liquidity. Year over year, cash position in the industry increased $1.5 trillion or 91%, second highest in industry. Deposits increased $3.3 trillion or 23%. The next highest annual growth rate in the industry, going way back to 1984, was 11%. So it was an extraordinary year of growth. Credit performance actually wasn't bad. The allowance position for the industry in general was bolstered. Charge-offs didn't really ever become that apparent. It averaged 50 basis points at an annual rate during 2020 for the industry. You think back to the Great Recession, charge-offs peaked at 3%. So the level of loan and credit difficulties for the industry, despite the extraordinary economic environment, was much less than expected. Provision expense increased significantly for the industry. CECL, a new accounting standard, probably had something to do with that, in addition to the difficult economic environment. And the allowance for loan losses rose for the industry up 100 basis points to 2.18%. As a result of all those dynamics, earnings for the industry declined $85 billion, or roughly by a third, 36.5%, to $148 billion for the year. Return on assets declined 57 basis points to 72 basis points, and return on equity for the industry declined 450 basis points to 6.88%, levels well below the last decade or so. Take a quick look at how our performance compared to the industry. Up on this table, the industry data is in the green shaded portion of the table. W.T.B. Financial Corporation is in the blue shaded portion of the table. I make a couple observations. Provision expense elevated for both us and the industry in general. And you can look at the various components of the income statement there. You go to the bottom line, net income for the industry down roughly $85 million or 36%. Net income for W.T.B. Financial Corporation down roughly $7 million or 8.4%. Interestingly, when we look at pre-provision net revenue, or what we refer to as the earning power of the balance sheet, which is essentially net income with taxes added back and provision expense added back, earning power for the industry went down almost 10%. Earning power for W.T.B. Financial Corporation increased almost 20%, or by $21 million during the year. Take a quick look at kind of the fintech landscape, which continues to evolve, continues to bring innovation and some disruption to the industry. The technology side of our business is very challenging. The increased level of our dependency on outside vendors is making us look at our vendors differently, much more strategic partners, and managing those relationships much more carefully. The transformation and innovation and evolution of technology is making it crucial that we rationalize our platform and get it as integrated as possible so it works as efficiently as possible. Executing and delivering all that technology to our clients through new capabilities and electronic banking features and functionality is a crucial part of what we do. And technology spend, we can expect that to continue to be significant in the years to come. In terms of W.T.B. Financial Corporation's 2020 performance, let's try to put it in perspective. Assets and shareholders' equity, we'll start there. Asset growth during the year was dramatic, up $2.6 billion or 37% in the year 2020. A big driver of that was the PPP loan program, but also significant organic deposit growth in the second half of the year. Shareholders' equity was up $111 million or 16% in 2020, primarily driven by earnings and improved bond valuations. And we'll see in the first quarter of 2021, rising rates are taking back some of those unrealized bond gains. As a result of dramatic growth in the denominator, total assets, our equity to asset ratio came down pretty significantly, almost 150 basis points to 8.22%. We look at that and say to ourselves, our capital quality is high, and the vast majority of that balance sheet growth resides today in cash, low-risk bonds, and government-guaranteed PPP loans. So yes, our balance sheet has grown. Yes, that helped drive our equity to asset ratio lower. We still feel comfortable in our capital position given the nature of the assets that we added to the balance sheet. In terms of investable cash and securities, you can see, as I was mentioning, the increase in our bond position and cash position at year-end 2020, $2.6 billion worth of bonds and almost $1.5 billion worth of cash on deposit at the Federal Reserve. That increase of $1.6 billion in our liquidity position year over year was 67% growth. Again, deposit growth during the year, driving an influx of cash, driving cash and bond position higher. In the bond portfolio, really reflected the significant deposit growth during the year. Our liquidity position ended the year at record levels. Low rates, the low rate environment is complicating our reinvestment opportunities, making it difficult to deploy these assets profitably and responsibly. In terms of deposit portfolio trends, for the year, deposits up $2.5 billion or almost 40%. Remarkable growth. Much of that growth came in non-interest bearing demand. In the first half of the year, the growth was primarily driven by the PPP loan program. Second half of the year, with deposit growth of $1.2 billion, was essentially all relationship growth from our deposit customers. Non-interest-bearing demand almost making up 50% of our deposit base, helping to drive our cost of funds lower, which ended the year in the fourth quarter really at a historic low for us of 13 basis points. Loan portfolio trends. Again, PPP loan program here is really the big story in 2020. Loans were up $1 billion or 23.1%. You can see the mix of loans on the bottom. Historically, commercial real estate and commercial and industrial loans balances have been roughly equal. The PPP loans that we put on this year, almost $1.2 billion worth, predominantly reside in C&I loans. So C&I loans moved well ahead of CRE loans in terms of asset mix in our loan portfolio. In terms of capital, capital levels and ratios remain strong. Equity equals $807 million, or 8.22% of assets. Again, as I mentioned earlier, down almost 150 basis points year over year, largely due to growth in the denominator. Our regulatory capital remains well above regulatory minimums. Unallocated capital, our capital position above regulatory minimum requirements, $202 million or 306 basis points. Capital quality is high. We have no intangible assets. Backing up our capital position is a strong allowance position. Our allowance position grew significantly in 2020 as a result of the uncertainty of the credit picture and the economic environment. We ended the year at $133 million in our allowance for loan loss position, representing almost 2.4% of loans. And if you take PPP loans out of the denominator, which are government guaranteed, our allowance position finished the year at 2.88% of loans. Retained earnings growth was funded largely by earnings, $76 million through the year, and improved bond valuations during 2020 as a result of the decline in rates. And I note here, as rates rise, we will give some of those unrealized gains in our bond portfolio back as our bond portfolio revalues. Overall, big picture, balance sheet growth in 2020 up $2.7 billion, and that growth was essentially comprised of cash, securities, and government guaranteed PPP loans. If you look at our capital ratios, we are tightest on our total risk-based capital ratio in terms of dollars, $262 million above regulatory minimums. And in terms of percent, we are tightest on our leverage capital ratio, where we are 306 basis points above regulatory minimums. Credit performance. Credit was a difficult topic in 2020 because of the uncertainty and impact of the economic environment that we all found ourselves in. But credit performance through the year remained pretty strong. Non-current loans remained at low levels, less than 25 basis points on total assets. Charge-offs were less than recoveries every year for the past 4 years. And non-pandemic impacted borrowers are generally in a very strong and liquid financial condition. Our internal risk ratings do show some isolated rise in difficulties, mostly pandemic impacted clients, but those clients are also the ones that have benefited from the PPP loan program and some loan payment deferral accommodations that we made, helping them stay current on their loans and helping them withstand this difficult environment. Again, our allowance position was strengthened during the year, boosted by $36 million or 38% to bolster that allowance position to $133 million or almost 2.4% of loans. But there hasn't been a flood of true credit difficulties leading to loan charge-offs. And so that allowance position sits there as a storehouse of balance sheet strength giving us some protection against potential loan difficulties in the future. In terms of credit relief during the pandemic, there have essentially been two rounds of PPP loans. One was back in April of 2020, and in that round we originated more than $1.3 billion of PPP loans. Then there was a second round more recently here in the first quarter of 2021, where as of the end of the first quarter we had originated $413 million of PPP loans. So grand total, we've originated $1.7 billion of PPP loans, providing valuable financial relief to our small business clients. And there have been roughly or a little more than $500 million of loan paydowns since the program started, leaving us today with a little over $1.1 billion in PPP loans still on the balance sheet. In addition to that, we made loan payment accommodations to certain borrowers, and at its peak, it totaled roughly $538 million. As of the end of 2020, less than 20 clients had any kind of loan payment accommodation still in place, representing loan balances less than $15 million. So that was a strategy that we pursued in the depths of the difficulties of the pandemic to provide some payment relief to our borrowers to help them get over that hump. In terms of credit performance metrics, again, interesting through an extremely difficult economic environment, non-accrual loans and ORE declined in 2020 from 2019 levels. You can see in the lower left-hand corner of the slide, our allowance for loan loss position went up considerably in 2020. And I've used a dotted line there to reflect our allowance to loan loss position at year end if PPP loans, that $1.2 billion worth of PPP loans that were on the books at the end of the year were excluded, since they are government guaranteed by the Small Business Administration. That takes our allowance position up to 2.88%, an historically high number for us and the industry in general. And again, in terms of loan charge-offs, recoveries have exceeded charge-offs every year for the past 4 years. So there's some numeric and kind of payment-based evidence that there's a fair amount of stability in the credit side of our loan portfolio. We also have a wealth management division that we've run for many, many decades. It's a key business line. It complements our banking book. It's a competitive advantage for high-profile and affluent customers. It again aligns with the notion of long-term, relationship-based business model. There's some attractive financial dynamics with that line of business. It provides stable fee income year over year. It's a recurring revenue stream. It diversifies our revenue stream from our banking side of the house. It's an off-balance sheet business line, so the assets that we help manage on our clients' behalf are not on our balance sheet, so therefore we have essentially no capital impact from those assets. And the wealth management division has almost $7.5 billion of customer assets that they manage, and that's been over the last 5 years almost a 12% compound annual growth rate in assets under management, and a 6.5% compound annual growth rate in revenues over the past 5 years. In terms of the income statement for W.T.B. Financial Corporation, you can see there's a graph here that breaks the income statement down into its component parts. Provision expense is one that shows a pretty significant difference from 2019 in the yellow bars to 2020 in the blue bars. But if you step back and look at our performance in 2020, total revenues grew $36 million. So that's net interest revenue plus non-interest revenue. Grew $36 million during the year. Expenses grew 15. So profitability before taxes and before provision expense was up significantly year over year. You layer in provision expense of almost $30 million, and some increase in non-interest expense, another $15 million, and you get year-over-year earnings of $76 million, down $7 million year over year. But an additional almost $30 million of provision expense going to bolster our allowance position, strengthening the balance sheet. In terms of financial performance metrics, really growth in assets and growth in equity and overall growth in earning assets had a pretty significant role in some of our financial performance metrics because the denominators are growing on how many of these metrics are calculated. So return on assets down 37 basis points to 0.89%. Return on equity down 280 basis points year over year to 9.9%. Net interest margin down almost 70 basis points year over year to 3.28%. So both the dynamics of the environment with elevated provision expense, lower rates, and significant balance sheet growth has had some artificial impact, if you will, on some of these financial performance metrics that make comparisons year over year a little difficult. In terms of shareholder value metrics, net income again down almost $7 million or 8.4% year over year. In terms of earnings per share, down $2.50 or 7.7% year over year. In 2020, earnings came in at a little over $30 a share. The dividend level in 2020 was increased to $7.40, and book value per share was up $44.07, or more than 16% to $316 per share. Now, some of that is the impact of the decline in rates and the improvement in bond valuations, which we will give back some of that and have already here in the first quarter of 2021. But nonetheless, a nice performance across the board, and in particular with book value per share. The graphs at the bottom, you can see kind of a compound annual growth rate since 1997 on dividends and book value per share, both of them roughly about 8% compound annual growth rate year over year over the long cycle. Take a quick look at first quarter of 2021 highlights. Assets were up again almost $300 million in the first quarter to $10.1 billion, driven in large part from a second round of PPP loan originations that map to a second authorization by Congress for this program through the Small Business Administration. Shareholders' equity, again, in the first quarter declined $30 million to $781 million, in large part due to rising rates impacting bond valuations, which for our available for sale portfolio maps through to GAAP equity. First quarter 2020 earnings came in at $20.7 million, up 10%, or $1.9 million quarter over quarter. Provision expense of $6 million during the quarter drove our allowance position higher still to $139 million. Non-current loans did leg up in the first quarter by almost $23 million to $34.3 million, predominantly due to one large credit that had difficulties. And again, if you take out of the denominator all of our PPP loans, our allowance position at the end of the first quarter came in at almost 3% of total loans. Some closing thoughts. 2020 was, of course, a remarkable year in terms of the environment, but it was also a remarkable year in terms of our performance. And Q1 was a strong start to 2021. Lots of issues for us to navigate through as the year progresses and potentially into 2022 and beyond. We have to complete our participation in the second round of PPP loans. We're still active there, and it looks like PPP loan originations could top $500 million in this second round. We have a heavily manipulated and dynamic rate environment. The Federal Reserve is using extraordinary means to keep rates low, and that's having an impact on our business. impact on reinvestment rates, impact on prepayment speeds and refinancing activity, and so that will continue to challenge us. Maintaining our earning power with that rate environment will be a challenge. We also face loan forgiveness on probably the first round of PPP loans, which we're already well into, and that will also be a challenge to earnings. As of the end of the first quarter, we've crossed over the $10 billion asset mark, and that will have in the future some regulatory implications for us, and that are going to make us have to beef up some of our processes and staffing in certain areas. We also have the challenge of the return to office. The majority of our staff continues to work remotely right now. We've done so remarkably effectively. And of course, the vaccines have been released, and the time to return to office is coming. My guess is it'll be sometime this summer, maybe in a staged fashion, and maybe more fully back in office to somewhat of a new normal by this fall, but we'll see how events unfold. We continue to like our positioning, strength of the balance sheet, our success in executing on the PPP loan program on behalf of our customers, and a continuing strong customer base. We continue to have competitive success in the marketplace. So we have, I guess, cautious and guarded optimism for the balance of the year. We'll look forward to talking with you again next year and keeping in touch with you through our quarterly earnings releases. And as always, we appreciate your support. Thank you very much.